two developments that I see no one talk about in the industry. So these two formations, these two developments, I'm sure will make you better at reading price, no matter if it's happening on the higher time frames, lower time frames, or execution time frames. Price is fractal, and you can take advantage of these developments from every single angle, every single time frame. So let's start with the first one, the foundation of it. Let me get to the blank space right here. All right, so what we had in front of us right now is a clear bearish delivery, price dropping to the downside. And what we see from that point, price bottoms out and starts pulling back towards a bearish PD ray. It can be anything, bearish order flow, bearish fair value gap. This works even for support and resistance traders, supply and demand and all of that. Whenever price, after showing one-sided price action, and then it retraces into a specific level that's clearly standing out, but especially if it's not entirely around equilibrium or premium of the dealing range. So if we take our dealing range, what we would see from a bigger perspective right away is price running some of this buy-side liquidity right here. So what we have is a clear high. Then price bottoms out. Before retracing, it runs some near sell-side liquidity as well. So we would measure our dealing range regarding the bigger picture from this high to this low right here. So we draw it like this. This is where we have our premium. So for the example purposes, and there the specific price action model takes place, usually it's below the equilibrium where price didn't give a deep enough retracement. So let's say that this bearish PD ray or horizontal level, whatever, is inside of a discount of this bearish dealing range. In these type of formations, this is step one. When price retraces into that bearish PD ray, that's not looking entirely correct, and especially when there's still a lot of place for price to retrace deeper, if there are any buy side liquidity pools there on the way and bearish PD rays resting right above, this adds a lot of confidence to the fact that price is likely going to pull back deeper. But the first thing that I want to mention about this price action delivery, when price really just seals the deal and almost guarantees that it's about to pop higher, not continuing this trend right here. And I'm not saying that it will break this dealing ranges high, but what I'm saying is that price is almost guaranteed to give you a deeper pullback to the upside is when price reaches into the first barrier, again into whatever PD ray, and after that what it starts doing, it doesn't drop to the downside right away showing momentum, but instead it starts playing the sideways game. When that's the case, this is the most clear part that price is reacting to this level. And when price is reacting to this level, what we are seeing right here are signs of potential continuation into the direction of the most recent move. And the most recent move was to the upside right here. So this means that what we are about to get from this point is another bullish continuation, especially if we have something inside of the premium, like smaller buy-side liquidity pools, another bearish PD ray, let's say, sitting right around here or something like that. This is in most cases when price is not rushing to drop lower after reaching into this first bearish PD ray or the second or the third one, and it starts giving this type of delivery, literally just consolidating, not showing much direction. This is the first sign that price is reacting to this PD ray, not rejecting it, but reacting, because when a real rejection is taking place, you will see speed, momentum, sharp delivery, price leading candles. Let's say if this is a bullish or bearish candle, but it starts leading these candles with large wicks to the upside if we are talking about the bearish delivery. So if this gray rectangle, let's say, would be a bearish candle, price would start leaving stuff like that, and then it would drop fast. And again, I'm crossing out all of this formation right here, because if we get reactions, this is the first sign that even if after such consolidation like this, they would get candles like that, most likely what we would even see is a bear trap. Price dropping lower right here. A lot of early short sellers would start taking short positions right here, putting their stop losses above this high. And what would actually happen? Price would drop into these green rectangles. It would bottom out inside of the bullish PD race right here and attack this high right here, stopping traders out. So overall, it doesn't have to be dealing range as well. When it is a dealing range, it's just easier to spot it, especially when we have deeper PD rays resting above and all of that. But whenever price reaches into a specific PD ray, no matter where it happens, if we have any other areas for price to retrace into, or if the whole delivery is still just looking very odd and suspicious, whenever price starts reacting, reading indecision candles like this, most likely what will happen in most cases is price just running some of that consolidation into this green rectangles bullish PD rays and continuing higher. And again, sometimes to confuse you even further, it will throw you these type of deliveries when price runs the buy side liquidity first, then it will run the sell side liquidity into this same same bullish PD race and then continue pushing higher. Overall, these two expansion situations giving you consolidation right there in the middle. That was just a simple consolidation, price reacting to this first bearish PD ray right here. So now let me find you some examples of what I'm talking about. All right, so inside of this price action, we have pretty much two examples right here to talk about, and I think you will notice them right away. So firstly, let's talk about this one. We are using this trading view replay tool, and in this one, we want to be talking about the dealing range that we had. First thing that I want you guys to pay attention to is that a lot of traders looking at structures to price leaving this low, high, another low, and a higher high right here. What they would immediately start looking at after price takes out this low right here is that we had a shift in delivery. Okay, let's play along with this logic, meaning that we would focus on this dealing range right here, looking for price to top out inside of that premium side and continue from there pushing to the downside. So notice what happens in reality right here. When price starts pushing to the upside into this bearish fair value gap right here, notice what starts taking place. So let's play along. Let's say that price gave a shift in delivery right here. But again, we are not trusting that blindly because firstly, pay attention to this fact that once price reached into this fair value gap, it didn't go anywhere. It reacted to the downside, ran some sell side liquidity right here, some internal sell side liquidity left this low right here, and then price took it out, these two equal highs. This low became an internal strong low. And notice what happens after that. Price reaches into this same bearish fair value gap, and notice what happens. Price starts reacting once again. And what are these candles right here? What are these candles inside of this area showing us? These candles are showing us that price is not actually rejecting this bearish fair value gap. It's reacting to it. Price is in a form of indecision, and especially because price left this low right here, running sell side liquidity, blasting to the upside and taking these highs right here, revisiting this bearish fair value gap, and then showing a lot of indecision signs. What we must pay attention to is where price came from. The most recent delivery was bullish, and this is the green rectangle that I was drawing for you guys in that most recent example. So from this type of scenario, a lot of traders are looking for potential shorts. A lot of traders are looking to target all of these lows right here. But in reality, what happens? Notice that price ends up delivering another extension because this is a simple reaction, not a rejection. So after we get these signs of reaction, indecision signs right here, what price ends up doing, you look at the most recent move and where price came from. It came from the downside delivering a bullish expansion. It reacts to the same PD ray and ends up delivering another expansion, taking out the buy side liquidity right here, fooling everyone with this fake market shift that at first look pretty good, but then we follow all of these small signs of price delivery. Price clearly tells us that it's not ready to deliver to the downside. Another example that I talked about that we had very near the current price action was this delivery right here. Let me delete all of these drawings. So notice that price is very clearly in a bearish delivery right here. If we focus on this most recent price action, notice that it ran some buy side liquidity right here. So what we have at this point is a strong high. So once price bottoms out right here and starts pulling back, what we have is a dealing range. From this high to this low, what we have is a pretty clear dealing range. Now notice that price reaches into this first imbalance point that is clearly below the equilibrium. Price haven't reached into the premium and the premium PD race right here, and notice what it starts doing inside of this first imbalance point that it reached right here in the first barrier. So what price starts doing, it starts consolidating. It literally starts moving sideways, and some traders who are anxious to get involved start looking for potential entries to continue this bearish delivery, to continue on this bearish trend. Again, this delivery could take place on 5 minutes, 2 minutes, 1 hour, 4 hour, daily time frame, weekly time frame, whatever. This is how price moves in these type of scenarios. So then we start seeing that price is not actually moving anywhere. This is a first sign that price is reacting to this first barrier that it reached right here. Price is literally reacting. So what we can draw for ourselves right away is where price came from. And where price came from was this bullish delivery right here. So notice that price keeps on reacting, and what we can expect right after that is another potential continuation after the reaction ends. Not looking for shorts, but staying on the sidelines, letting price play out, especially when we have other PD rays. And notice what happens here. Price ends up delivering another expansion to the upside, even faking a lot of traders out with this candle, saying that, okay, now we are ready to drop to the downside. Psych, it runs sell side liquidity, leaves another strong low and blasts to the upside again, delivering delivering this exact green box delivery that we talked about. So what this becomes, this first fair value gap that price reached into and consolidated, this becomes the reaction. Price built consolidation, builds liquidity here, ended up running the high, then running the low, dropping into bullish fair value gap right here, rejecting it and blasting to the upside. So in other words, if we would zoom out, what price gave was this first expansion here, consolidation, run on the buy side, run on the sell side into bullish fair value gap, and expands to the upside, delivering a bear trap right here. So this is how price likes to move, and these signs are critical, absolutely critical regarding these specific developments. And again, remember that this type of delivery takes place very, very often. Now let's talk about the second development. This is one that I talked about before. Not sure how many of you will remember this, but this is absolutely critical whenever you're trying to see what EDO race you should focus on. Let's start with a bearish dealing range as well. Imagine we are seeing bearish delivery right here, and then it starts retracing. So let's say if we wouldn't have this clear high, that is in this case, what we would notice right away is that, okay, we have a dealing range. We have this strong high that ran buy side liquidity into this clearly bearish imbalance or even a DPR balance price range. And what we could draw for ourselves is a dealing range. And obviously we would start focusing on the PD raise that happened inside the premium. But let's say if we don't have this dealing range, let's say that this part right here doesn't exist. And I'm talking about this high. Let's say that what we had right here was not a strong high, was just a simple casual delivery, price leaving, regular price action, dropping to the downside. So in this type of case, once price starts pulling back, and let's say our magnet area, our main drawn liquidity is lower right here, what traders fail to understand is that most critical, strongest PD raise form right above, if we are talking about bearish delivery, right above low resistance liquidity pools. And what is a low resistance liquidity pool? In quick short terms, if we are talking about price action delivery, whenever price is either delivering consolidation, indecision type of delivery that we just talked about, or it's forming after, in a bearish scenario, after a high was left and price starts printing smaller, lower highs close to it. In other words, round formation, all the strongest bearish PD raise form either overlapping that right here or above it, meaning that no matter how far price drops, if it hits an opposing strong enough PD ray, let's say a bullish PD ray, this is when it opens ground for us. Even if we are bearish on division and our main magnet level is right here, this is when it opened grounds for us. Let's say if this is a 15-minute time frame delivery or 1 hour time frame delivery, this is when this type of formation opens ground for us after it shoots to the upside to look for potential scalp opportunities on the upside right here, aiming for this PD ray and this low resistance liquidity. Because again, in most cases, what price will do, it will aim for that low resistance liquidity that's overlapping or that has high probability clear PD ray above it. So let's say this is a fair value gap. This is when price will deliver exactly this buy side liquidity, this low resistance buy side liquidity into this PD ray right here, and only then it will actually drop towards your draw liquidity regarding the bigger target, the bigger direction. So this is what most traders fail to understand. They see a PD ray, let's say a bearish PD ray, that's almost right there in the middle of all of the low resistance delivery. Once price hits it, they start looking for shorts, when in reality, what most often price does, especially if it runs into some opposing bullish PD rays, it gives a deeper reaction. So it can run into opposing PD ray, it can run some sell side liquidity, sweep some sell side liquidity, start reacting to the upside. Let's say our magnet area is a bit lower right here. This is when our eyes go to the highest low resistance liquidity pool that has PD rays above it. And this is when price most often will deliver exactly to this point, stop out, and only then continue falling with the main direction towards the sell side liquidity that it falls right here and the main magnet, the main draw on liquidity. So this type of price action plays you must pay attention to. These are absolutely critical to have in your arsenal as a trader. These are absolutely critical to master, and these are the two that I haven't talked about much. I never talked about the first one. I have mentioned the second one in a couple of my videos, but that was a pretty long time ago as well. So I hope it was insightful. I hope you will be able to incorporate this into your trading. And as always, we will talk very soon. Take care, guys. Have a great day.